The hidden cost of playing it safe.
Oh, no.
Oh, I didn't know there was a hidden cost to playing it safe. We're going to talk Iron Condors, risk-defined, range-bound trades that consist of a short put spread and a short call spread. This is a Tasty Bite segment, so it's designed for smaller accounts between, let's say, under 25,000, maybe 2,500 to 25,000. So it's a smaller account. So we try to focus on more capital-efficient strategies. But so Iron Condors, just to talk about a specific spread, and Tony talked about, maybe Netflix is an Iron Condor candidate this week. Well, we'll see. But Iron Condors profit when underlying stays between the short strikes. And they are among the most popular neutral strategies for smaller accounts because you get to sell a call spread and a put spread, and they're pretty much like 60-40 or 65-35 risk reward, that kind of thing. But what exactly are the reduction in risks, and why aren't all of our trades risk defined, especially when scaling our accounts? And are defined risk strategies all they're cracked up to be? Compared to a naked strangle, adding 10 delta wings reduces CVAR by 66%, reduces buying power reduction by 85%, while reducing max profit by only 48%. Okay? So that doesn't sound too bad, right? Spy Strangle versus an Iron Condor using August expiration, 20 delta strangle. There you can see the $10,000 in buying power, 4,400 in CVAR, and credit of 5,200, 580. I'm sorry, 582. When you do the Iron Condor, 20 delta short with a 10 delta long, the credit's 300, but the CVAR goes down to 1,400. That's your kind of max loss, and the BPR is only 1,400. Same thing. And so the numbers actually look pretty good on this slide.
Yeah, and this is not the first time we've done research that shows this either.
Let's go to the next slide.
Showing the benefit of the Iron Condor.
So for small accounts, the benefit of reducing trade risk and capital usage is being able to put on many different positions. We've talked about the number of occurrences many times in our research, and studies in redeployment is one of the best ways of achieving that. But then two questions pop up. Why not always trade defined risk, even for larger accounts, and just size up on contracts? And could we go even more narrow and reduce the buying power and the buying power requirement and the risk even further? Well, sizing up on risk-defined trades generally results in more risk than a strangle. That's weird. The Iron Condor has lower P&L and more frequent CVAR occurrences than a naked strangle, meaning that increasing size comes with large and frequent CVAR losses. And this is a really interesting slide. This is the downside, the hidden cost, as they say. The average P&L of a strangle is better than Iron Condor, okay, but the win rate's very close to the same. But the probability of reaching your max loss on an Iron Condor is 3 times what it is in a strangle. And max loss in a strangle is defined by CVAR, not by something else. So narrowing an Iron Condor simply reduces the credit, the CVAR, and the buying power across the board at nearly the same rate. So essentially, you're just spinning your wheels. So we don't do narrow Iron Condors. You've seen that for a long time with us. We get out of the narrow Iron Condor business a long time ago. Just not worth it, because you are essentially just spinning your wheels. The percent reduction is exactly the same. You're better off doing the strangle if you have the capital. So simply adding long wings may not be the answer. Even though we still have access to defined risk trades, be aware that a fixed width spread or an Iron Condor and underlying that increased significantly in price sees its pop greatly reduced. So in order to get the same pop that you had, for example, in 2020, your wings on a 20 delta IWM Iron Condor need to be $20 wide, making it less feasible for smaller accounts, partially due to the added skew. All we're saying is that as these markets have gone higher, the IWM Iron Condor was much more attractive with strikes $5 away in July of 2020 than it is with the index significantly higher in July of 2025. That's a super interesting statistic.
Absolutely.
Let's go to the next slide. So small accounts tend to be capital constrained from doing undefined risk trades, which is why Tasty Bite traders often opt for risk-defined trades. So how can we strategically choose undefined risk strategies like strangles and short puts and calls so they would be available to smaller accounts, maintaining the benefits of undefined risk trades? Okay, spoiler alert, it has to do with implied volatility. So when using undefined risk trades in low IV stocks, you get a sizable increase in BPR. However, in higher IV stocks, the percentage increase in BPR is much less, allowing you to use more undefined risk. So it's a better ratio. So we have here is really interesting buying power reduction, looking at Walmart and UAL, because they're both $95 stocks at the time when we wrote this. UAL has dropped a couple dollars since then, but when they were both 95, the implied volatility of UAL is significantly higher. So the Iron Condor, you collect the same amount of money. The one standard deviation strangle, the one standard deviation strangle, you have to put up significantly more money in Walmart. And so the percent in buying power difference is significant. So all they're saying here is that it's much more capital efficient to trade something with a much higher implied volatility.
I get it. And that's what you would think.
Let's go to some of the takeaways. By trading an Iron Condor without getting too narrow, you can reduce the tail risk and the capital components that come with strangles while maintaining a reasonable credit. However, be careful of sizing up more contracts or getting too narrow. Sizing up defined risk trades results in more risk than a strangle, and narrowing the long contracts doesn't optimize anything and can reduce your pop even further. So defined risk strategies cost 25 to 40% of the credit received. However, undefined risk in high IV stocks offers a better credit to buying power ratio and smaller BPR increases, making undefined risk a suitable option for smaller accounts if done optimally. This is a really good piece on the hidden costs of playing it safe. If you're not subscribed, subscribe right here. And if you want to meet me and the team in person at our next live event, hit the link at the top of the description.